Here we are with EMS The Accounting Cycle. Alright, so first of all, we have the beginning of the cycle, which is there's nothing yet. Then there is a transaction, and after a transaction, when you do the transaction, you get a document, correct? Like a slip or something like that. You can use this document then to record it in the journal, like the cash journal. Then it will go, if you have the cash journal, the payments and the income cash journal, you can record both of them in the ledger. Then you can get a trial balance to see if it balances out. You'll have financial statements to see if you have a loss or a gain for that year, and then that is the end of the cycle. So just as interesting sake, so for South Africa we usually start our cycle at the beginning of March, and then it goes the whole year, and then that's at the end of February is the end of the cycle. Alright, so let's look at transactions. A transaction is an agreement between a buyer and a seller to exchange a good or a service for money. For example, when you go to the hairdresser to have your hair cut, you agree to pay the hairdresser a set amount of money for cutting your hair, right? So this transaction would be recorded in the first step in the accounting cycle. The following information is necessary when recording a transaction in the books of a business. Sorry, just this bird again. Let me quickly. Okay, so the following information is necessary when recording a transaction in the books of a business. First, you need the date of a transaction. That's usually on a slip. If you look on any Pick n Pay slip, you'll find it there. The parties involved in the transaction. That's, for instance, Pick n Pay and yourself, that's the parties involved. The amount of money involved, let's say you bought a chocolate, then that would be like, what does chocolate cost these days, 15 Rand or something. And the reason for the transaction, well, yeah, you wanted the chocolate, and the source of the document. So proof that the transaction took place. So the source of the document will be your slip. The source of the documents, let's look at that. A source document is an original record that contains the details of a transaction that has taken place. So all of the details here is on the slip usually, and that is what source document shows. It shows you where the transaction has taken place. So for instance, at Pick n Pay, the source documents are always completed in duplicate. So I don't know if you've seen, but if you go to Pick n Pay, for instance, you get a slip, and also they keep one, especially with card payments, and they keep it in their little till. So there's two of them, one for the business and one for you. For example, here's an example. At the hairdressing salon, once the hair has been cut, you pay for the service at the till. And then the hairdresser gives you a cash register slip, which is proof that the transaction has happened. And the hairdresser also keeps a copy of that to show herself that the transaction has happened, or himself. Number 3, subsidiary journals. Now, the source of documents are then recorded in a different journals known as subsidiary journals. So you have all cash received is recorded in the cash receipts journal, so the CRJ, and all cash paid out is recorded in the cash payments journal, the CPJ. So the cash receipts journal, so when money is received outside the business, for example, from rent received, the source document would be the duplicate receipt. Capital contribution by the owner. So let's say the owner wants to put money into the business. There will also be the source would be the duplicate receipt. Money receipts from rendering a service. So if you did a service, like for instance, my brother is an electrician. So he goes to work at people's houses, and then he sends them an invoice and they pay for it. And then I will send them a proof of pay that they paid. So a proof of payment to say thank you, hey, thank you for the payment. So they will have a duplicate receipt or an invoice or receipt of the invoice. Deposits into the bank account. Yeah, some people still use cash. They deposit it into the bank account. So then you will have a duplicate deposit slip that you can have. And then the transfers directly into the bank account. Most people use this nowadays. For my brother's business specifically, I send them the invoice and they pay it into the bank account. They usually use their invoice number as a reference, so I can see who paid something into the bank account. So the transfers directly into the bank account of the business, and this you can see on the bank statement. The bank statement comes once a month. I was usually on the 5th, so on the 5th I will check who has paid, and then if there's some people outstanding, I will just send them the invoice again. So this you can all see on the bank statement. I will show you some examples from my brother's business so you can see how it works in real life. So cash payments journal, the payments by a check counterfoil, the art of the check that remains in the checkbook that is used to record transactions. Now, checkbooks doesn't really exist anymore, but I'm guessing the art of it still stays in accounting in some way. So transfers directly from the bank account of the business bank of the business. You will also get those, like I said, from the bank statement. And this you will all put in the cash payments, things that you paid out. So you can also see that. You can basically, these days, if you don't buy anything cash, you can see everything on your bank statement. It's the only thing I really use. Because people don't usually use cash anymore. General ledger. The general ledger is a journal that is completed every month in both the cash received journal and the cash payment journal. These journals are then summarized to make it easier for the bookkeeper and to keep an accurate record. The general ledger is used to summarize these two journals. And for example, in a year of selling, the total sales were recorded into one account called the sales account. And all these amounts will be transferred from the journals into the general ledger, and this is called posting. If you transfer amounts from the journal into the general ledger, it will be called posting. The amount will go either on the debit side in the general ledger or on the credit side in the general ledger. Trial balance. Now, a trial balance is a list of accounts which appear in the general ledger, showing each account's balance. So let's say for a Pick and Pay, and then for ShopRite, and maybe the plumber, and everybody, maybe you have multiple accounts, then that shows the balance of each account, and it is used to test the application double entry principle, so to see if everything adds up. In the general ledger, the account will have a debit or credit balances. The trial balance has debit and credit side. Okay. All the accounts in the general ledger with a debit balance will be entered in the trial balance on the debit side. So debit stays on the debit side. Income statement. Income statement shows if a business has made a profit or a loss. A profit increases the business's wealth, which makes sense because there's a surplus of money, and a loss decreases the business's loss, which makes sense because there would be a negative amount of money, which money that you don't have at all, so it's definitely a loss. A profit will increase the owner's equity, which also makes sense, he's worth more, and the loss will decrease the owner's equity, which also makes sense because he would be worth in a less amount. Balance sheet. A balance sheet is a statement that reflects the financial position of a business at a specific date, so any specific date. The balance sheet reflects the assets, the liabilities, and the owner's equity of a business. A balance sheet and a personal statement of net worth are the same thing, okay? So a balance sheet and a personal statement of net worth are the same thing. And maybe I can show you when we study this together. On my banking app, I can get an instant net worth, what I'm worth as a person in money, which is not a lot. I can tell you, I think it's a negative, but I will show you. And then the balance sheet and the net worth is then the same thing. In the balance sheet, total assets must equal owner's equity plus liabilities. Okay, so the balance sheet has the assets equals the owner's equity plus the liabilities, which makes sure, so owner's equity is how much the owner is worth plus the liabilities, what you need to pay and all those things, what you are responsible for, and that equals the assets that you have. And that's the end of that. I want to look at the picture that was posted on Google Classroom today. Now, this is a very difficult picture to see because this was posted, I think, by someone in your class. So here we have the instructions for when doing the accounting equation. Now, remember the accounting equation. We'll just go back to that. Oh, different one here. So this is also the a photo that was posted on your Google Classroom. So here we have the accounting cycle, which is a transaction, the source documents, the journal, the ledger, the trial balance, the financial statements, which is the income statement, and the balance sheet. So the accounting equation is, remember, the assets equals the owner's equity plus the liabilities. Okay, so it's important, accounting equation. So let's read the steps for the accounting equation. Number 1, read the transaction and make sure you understand the transaction. What do you need from the transaction, right? The date, who it's from, the amount. Write down the amount. Oh, here we go. In the transaction. And then you 3 identify the account name. So the account name would be, I think, for instance, Pick and Pay. And then you would classify the account. Is it an asset? Is it an owner's equity? Is it income statement? Is it expenses? Is it a liability? So here is the conclusion. I don't quite understand this yet, but I'm going to take a guess. So don't take my word for it. We will figure this out when I'm with you if we can actually look at the book. So debit and credit side, right? So for assets, you will plus the debit side and minus the credit side. And for owner's equity, you will minus the debit side and plus the credit side. And for liabilities, you would minus the debit side and plus the credit side. Now, let's look at what these liabilities and stuff is. So at assets, there we go. Assets are all of these things. So that's like land and building that you own, equipment that's in those buildings, machinery that's in the buildings, vehicles that's outside the buildings, your trading stock, your debtors, your bank, money in your bank, your cash float. That's all things that you own. The assets are things that you own. Cash float and your petty cash. Those are all things that you own. So assets are things that you own. Just think like the building what's in the building, the machines that you use, the vehicles that you drive with, the trading stock, because that you own that, your debtors, your bank, you own the things that's in your bank, and your cash float, you own that cash and the petty cash. Liabilities, oh damn, time's running out.